Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thank you for tuning in, and be sure to hit that subscribe button on YouTube, BitChute, SoundCloud, whatever platform you're listening to, or get us on the RSS feed of your podcast application. And it's a very newsworthy day today. The official inflation measure came out, and we have none other than Robert Kientz with us. He is the editor of goldsilverpros.com, and also he wrote Drop Shadow the Truth about the economy. So there's a lot to discuss. Robert, pleased to meet you. Welcome to the show.
Thank you very much. It's a pleasure to be on with you.
Right on. And just like you, we've been exploring this or poking holes in this idea of this transitory inflation and what this means for everything, because it seems like, the central planners have basically cornered themselves, and the year over year was 6.2. They have cornered themselves. What can they do at this point in terms of trying to address inflation with seemingly no real tools at their disposal or lack of willingness to do so?
I would argue that because 40% of M1 money supply ever created in the history of the Fed dating back to 1913 was created in 2020, they actually caused the problem. Now, you could argue that there was money printing before that and that there were heavy debt and deficits dating back to the Reagan administration. I won't argue with you there. You could argue that Nixon taking us off the gold standard in 71 contributed to this, and going to a pure fiat system during the central bank era contributed to this. But the Fed's always been front and center. And they're the ones that printed the money, whether we needed that to get out of the issues we were in, the pandemic or not, the shutdowns. The money printing, if you follow Austrian economics, it's inflation in the money supply and then inflation in prices. That's always been true throughout history. And that's what we're having now. We had a huge creation of money supply. And now we're having inflation. What's different this time is that previously, as they were inflating the money, it went into paper assets. It went into things like, and into houses. So house prices went up. The stock market went up. So if you held those things as assets, you could, it didn't hurt you as much, any inflation you saw in prices. And the CPI stayed fairly, steady and calm for the longest time. But with that much money supply being printed, not only in the U.S., but look at China. China has outprinted the U.S. since the Great Recession, by the way. A lot of people don't know that. So there is money printing across the world. Eventually, all of that money is going to reprice all the supplies in the world, and that's exactly what's happened. We saw it at the beginning of the year. We said the commodities complex is on the rebound. Prices are surging, on the GSCI and these other commodities indexes, the S&P. We saw that. And then we saw the PPIs, the producer price indexes, start to spike. Not only in the U.S., by the way, the Chinese just printed a 13.5% PPI, producer price index in China. Their producer costs are rising ridiculously. And then, of course, it comes into consumer prices. It just flows right down the supply chain, and that's what happens.
Oh, but I'm going to have to stop you there. Well, okay, because I don't think there's anyone would even, that's a strong statement. It is the case that the combination of expanded monetary supply with the impediments to the economy, to production, has brought this about. However, my real question is, what is going to happen now, right? What can we expect in the next 6 to 12 months? Will there be any degree of remorse or taking responsibility and actually turning the ship around?
Well, the Fed's stuck. So I guess to answer your question, they're stuck. They have stated they don't want to go negative interest rates. They don't have 5 to 6% interest rate to cut like they did during the Great Recession. We're just sitting effectively zero, right above zero. They don't want to cut unless they go negative. We've seen the negative experiment in Europe. It's not going so well.
Yes, but why would they go negative when they're in such a high inflation scenario?
Well, traditionally they would raise rates So traditionally, you raise rates during that scenario, like Paul Volcker did, raise rates to fight inflation.
Yeah.
It's to slow down the velocity of money and to slow down or to slow the system overheating. So if you think the system's overheating, they're going to raise rate. The problem is the last time they raised rates, and they did it for a while, you had that 20% correction in the stock market in quarter four of 2018. I don't necessarily think that's what they want to happen, but I don't think they have a choice. So, but again, either policy move that they make, they're between a rock and a hard place. If we hit a recession, they can't cut. If they raise rates now, it's going to cause at least a stock market crash. Who knows if it'll lead us into recession? They're in bad shape. And the reason I bring both points up is because they do both. But the problem is they can't do either right now in whatever order that you want to put them without issues. And that's the problem. This is how it's different than 2008, 2009. I'm presenting to the OTC markets tomorrow, and the title of my presentation this time is different. That's why. Because we're in a different situation with the money, the debt, and the interest rate situation than we were back in 2000 during the tech crash and in 2008, 2009 during the mortgage crisis.
Yeah. So basically, you're saying that they're almost paralyzed at this point.
They are. And, to be fair to Powell, this is not all of his doing. This is the position we're in is the position we've all accepted as a market, not just the Fed, but as a market. For years, we all said, hey, we're going to support this system, in some way. Some of us have complained about it, but it's the system we're in. We've all enabled this. And I don't think it's all Powell's fault. I think it dates back to Greenspan and even beyond that. But it is a situation we're in. And the question is, are we at the end of this cycle of the system? How does the dollar survive and what iteration does it survive? If the Fed doesn't have any bullets in its gun right now, what does that mean the next time we have a crash? We're going to have a crash. It happens every 4 to 10 years on average. We're now 12 years into this bull stock market.
Yeah. So
what happens next?
At this point, I guess I'm taking from you a few different messages. One is that we can just expect inflation to continue on.
Of course.
Yeah. Second, yeah, there will not be any major action from the Federal Reserve. And I guess another one is that you're expecting some kind of major correction.
Yeah, I think anybody who's studied markets knows we're due for a major correction. If you look at P&E ratios, and if you look at CAPE, which is cyclically adjusted P&E ratios that Benjamin Graham, David Dodd, and was one other economist put together. I'm drawing a blank. They developed PE10, which is price to earnings over a 10-year rolling average.
Yes.
We're at the second highest in history. The last highest was the tech boom. And what happens when you get into that fifth quintile of those, which is basically above 80%, historically above the mean of the CAPE or the PE10, you have a crash and it reverts below the mean and it goes to the single digits pretty much every time. So if you're looking at the best indicator of overvalued stock market in a correction over time dating back to 1871, since they've collected this data, and the data provided by Standard & Poor's, right? So the Standard & Poor's has a lot of the earnings data, of course, during the market. So if you look at that, we're due. I don't think it's going to happen quite yet because I think it needs to get to that fifth quintile to where you have that big correction, traditionally speaking. Doesn't always happen. It's gone to the fourth quintile and corrected. But I think it's going to go to the fifth. We're sitting at 80% right now. So we're at the edge of that fifth quintile. I think, yeah, the correction is imminent if we look at history. Now, could we break the historical trend, dating back to 1871? Sure, we could. What are the chances of us, doing that with the economic issues we have? I wouldn't be confident in that.
Yeah, there's a lot going on. And as you mentioned on your own show, the Evergrande default is going to maybe catalyze or hasten any kind of correction. Do you want to comment on its relevance or importance?
So the property market in China is $62 trillion. It is the largest single asset class in the world. It dwarfs the U.S. stock market, the U.S. bond market, the U.S. real estate market by almost a factor of 2. All of those are around 30 to 40 trillion, give or take. So this is huge. And it's not just Evergrande. It's Cynic. It's Kaisa. Kaisa Evergrande, and Cynic have all been downgraded in the last 2 days by Moody's, S&P, and Fitch. So the entire property market in China right now is taking an extreme hit. China right now, the politicals class has asked their think tanks to come up with a solution. And they've asked their state-owned entities to take on some of the stock of these property developers to stabilize them. So China hasn't officially, from a central bank perspective, bailed out these property developers, but they're asking for assistance from other economic actors to stave off what looks like a major debt default situation brewing in the largest single asset class in the second largest economy in the world. Now, the question is, it's obviously bigger than Lehman. If it's the largest asset class in the second largest economy in the world, if China doesn't act quick enough, does that spread? Who owns it? There are offshore people that haven't been paid by Evergrande. Who are they? How far does that contagion spread? How do we stop it? Does the Fed have to get involved? Does the ECB have to get involved? What happens there? That's a big question. And nobody knows the answer to that question because you have to unravel all of those financial relationships. And I'm not sure that everybody knows what they are, but we know that there's a lot of foreign direct investment into the property development of China. So we'll have to see how bad that gets and how that spreads to the rest of the world and within the banking system.
And one other implication of just long-term higher inflation in the United States is the undermining of the U.S. reserve currency status.
Right.
So, of course, the U.S. has had this basically since the Bretton Woods Agreement or, after the Second World War. So, are we in the final days? Not days, years, you might say, of such U.S. dominance?
If you listen to James Rickards and other popular economists, I believe James Rickards spoke at the New Orleans Investment Conference, as he usually does,
Sure.
and other popular economists. Once a currency goes full fiat, meaning it's not gold backed, so in the U.S. that would be 1971, so about 50 years. They last about 50 years. That was true of the British pound and all of the previous pure fiat currencies or a currency not backed by a precious metal. They last about 50. So the dollar's a little long in the tooth. I would argue that the political structure and the military structure underlying the dollar are a little bit different than what we saw in Britain. However, I don't think the U.S. is going to escape forever. I just don't. I think eventually, the dollar in its current format is not going to be the dominant currency again. I happen to speculate and believe it will be a multipolar world where the Chinese yuan will be there, whatever iteration of the euro will be there. And then you have to talk about central bank digital currencies because all of them, China, the central bank, the Fed, the Bank of England, have all mentioned they're going to central bank digital currencies. When the dollar era officially ends, the Bretton Woods era officially ends, does that mean they all say, hey, let's just transition to the digital version of this? The IMF has a position paper out since 2015 that says that's exactly what they should do. The IMF has said this is the model you should go to. The BIS has come out and said, that's probably where we need to go. 50 of the world's central banks have said we're considering it. So whenever the dollar finally does die, or at least stops being the world reserve currency and gets revalued, however it gets revalued, when currency crashes happen, they get revalued. What will emerge is probably a new system that's going to be more digital. It's going to involve more direct payments from the central banks to businesses and individuals. We know that's the structure of it. How does that change things? I don't know. It would be very interesting. I feel like we're going into a new monetary regime, much like we did during, Bretton Woods and after World War II. I think this is a big change. This is a big cycle change.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
This is the Inventa Mining Update. Inventa is a sponsor of the Gold Newsletter podcast, and I'm always pleased to be able to do these updates and to stand in for Brian when he's not available. So I'm eager to learn about these mining companies. We have Michael Connert of Vizsla Silver Corp. That's VIZSLA. The ticker for Canadians is VZLA on the Toronto Venture Exchange. And for Americans, if you look it up, it is VIZSF. So he is in Vancouver, which is obviously a huge mining hub. and he has a major project going on in Mexico. So, Michael, welcome to the show. And tell us, you've been getting lots of results. Your prices have basically gone up by 50% in the last couple of months, your stock price. So you must be pleased with what you're finding.
Yeah, thank you. First of all, Fergus, it's great to be on the show, and thank you for having us. We're very proud sponsor and enjoy being here. So, I think if you could summarize the last few months of what we've been doing here at Panuco with a couple of words, is it's getting bigger. I think would be, in one word, it's bigger. We're really pushing forward with the resource drilling on Napoleon and Tajitos. The strike length of both of these veins, which are the main veins of our resource area where the 10 drill rigs are turning right now, has increased in multiples over the last year. And just recently now we've grown Napoleon by 700 meters to a total of 1.7 kilometers or 1,700 meters along strike. And then Tajitos we've expanded now to 1 kilometer. So, Tajitos originally was what we suspected would be kind of a couple hundred meters of strike. And now it's gone 5 times our expectations. We expect that to continue to grow. Tajitos is really blowing our minds right now.
Yeah, so your latest drill results came out on November 3rd, so just about a week ago. And people should read, if you're not already, get subscribing to the Gold newsletter, the monthly PDF release. We have a great profile of the company. And Brian London has this as a strong buy. And he's just saying that there's so much news coming out lately. So obviously the rise is not one of a secular trend. It's specific to this company that there's been a lot of news. And people will know too that obviously gold is really just starting to get a little bit exciting, a bit exciting. How close do you follow the broader gold price, or silver, in the case it's silver you're dealing with, how close do you follow the actual prices as opposed to just the mechanics of building the project?
Well, I would love to be able to spend more time on the precious metals, but the fact is, that we're confident that silver and gold are going to rise here. We built the company to position ourselves for that. And most of my time is spent, focused on making sure that Vizsla is a success. And that means, paying attention to what's happening on the ground and what's happening in our organization and optimizing that for success. So, I have kind of this implicit faith that I think silver and gold will do well, and I find it incumbent on myself to just make sure that Vizsla is in the best shape possible to execute on our business plans here.
And why don't you give people a sense for the timeline, the lifespan of this mine, how long you've been overseeing it, and its prospects? What are the next upcoming events?
Well, many of the followers would probably know that this is a very old district. We're just the first company to actually have come in and consolidated. It's been in production for over 450 years. It was founded by the same person that founded Fresnillo and Durango. So very old district. Now Vizsla has only been working on it for about 2 years now. And over the last 2 years, we've done an incredible job of consolidating the district. We own it 100%. We have 10 drill turning. We have $50 million in the bank. And it's got to be one of the world's most exciting exploration programs. But the next steps here, on Tajitos and Napoleon, we're moving forward to our initial resource in Q1 of 2022, so next quarter. And
right.
We're very excited about what can come out there. Looking forward past that resource, there's so much more exploration to be done. Napoleon Tajitos, less than 5% of the overall vein strike there. We're going to find more veins. We're going to keep drilling here.
Yeah, as we were discussing before, so this is the Panuco project in southern Sinaloa, Mexico. We've discussed just 2 of the veins. You said maybe there are hundreds in this property. So a heck of a lot more action to come. And you think there's actually going to be some production in the first quarter. Did I hear you correctly?
We'll have our resource, our initial resource calculation in Q1.
Okay.
Production will still be, somewhat out. Although we
Right.
have production infrastructure on the property, we first need to drill the property before we go into production.
Right. So we're still in exploration, but a heck of a lot more here. And yeah, do check out the Gold newsletter profile. There's a great update from Brian London as to what's going on with Vizsla, and I'll get the producer to put the websites. It's a little bit of a mouthful, but it is VizslaSilverCorp.ca, and check them out for more details. Michael, thanks for your time.
Thank you, Fergus. Appreciate it.
Yeah, one of the frightening elements of this new monetary regime is that it is likely to have, as you alluded to there, an even more interventionist role from central banks.
Yeah.
Their roles as quasi managers of the economy.
Yes.
And to people who are skeptics or critics, that is a perilous thought, that we have an unelected group that will be dictating so many aspects of the economy.
Yeah.
Now, let's move a little bit more to practicality. One point you made in your own show was that you actually advocate holding some cash, right, for
Yes.
the near term. That seems counterintuitive. Why don't you explain why you believe that?
So I'll borrow from a lot of financial analysts that say use the bucket approach. So when I look at my assets, I put them in buckets. You've got your speculative bucket, you've got your savings bucket, your long-term savings. You have things like, investments, and then you got cash. And I consider gold and silver cash because actual bullion common dated coins, I just did this 2 weeks ago. Went to my local coin dealer, stuff I bought from him 10 years ago. I went and sold about $20,000. Had $8,000 cash in my hand, $12,000 check. That $12,000 check, my bank took it. 2 days later, I had that money. So relatively speaking, gold and cash is pretty liquid during normal times. So
Yeah.
in that bucket, cash, gold, and silver, common dated coins, not numismatics. But I think cash, the dollar bill will be king for a long time. If you think about people marry the money of the state, right? We've had the dollar bill since 1913. People aren't just going to slough it off. And even if the dollar crashes, it doesn't go straight to hyperinflation right away. You have big inflation, and then you have the confidence event, which leads to hyperinflation, like we saw in Germany and Zimbabwe, Argentina. In that time, you want cash, because what are people going to accept for your mortgage? Cash. For your rent, cash. For food, cash. For gas, cash. For whatever you're buying, cash. If you need clothing, cash. Cash will be king because people marry the money of the state. But if things get really hard, like when I interviewed Fernando Aguirre, who was he was Argentinian during the 2000 peso crisis. He said the dollar bill was king because the Argentinian peso had destroyed itself. But he said, Rob, the Argentinian peso had destroyed itself. So if we didn't have dollars in the economy, it would have been gold, silver, and it would have been barter. So yes, being the reserve currency, the dollar will be king for a while. But then I would say have your gold and silver, because whatever the currency is, whether we go to digital dollars or you have competing currencies come in, if people start trading euros or whatever the case may be, I mean, it could get really crazy. That gold and silver can be redeemed for any paper currency. So gold and silver to me is your ultimate, currency hedge. But I wouldn't get rid of cash. You're going to have some.
Yeah. So if you're more one of the people who are inclined towards the apocalyptic or doomsaying outcome, get the cash. But okay. And you said too, and this will interest many of the listeners because obviously we have an inclination towards gold and other precious metals and mining stocks, that you really see them as one of the diamonds in the rough during such a black swan or downturn period.
Yeah, if you look at gold and silver, they do very well when you have, like they did extremely well. 2011 gold hit its all-time high of like just over $1,900. A couple of years after the Lehman crisis. So it started to get bid up in that 2009 timeframe. It just kept going. Silver reached its all-time high of about 50, really about 49 something. But yeah, the precious metals do very well when you have any sort of crisis. Even if it's just a stock market crash. When the stock market crash I talked about earlier happened in quarter 4 of 2018, that started gold off of its cyclical low of about $1,000, $1,100 and propelled it to 2060. Okay, and that 2060 wasn't reached until last year. And I would argue that the pandemic played a large role in that. But if you look at the chart, it was a steady rise from about 2016 to about 2020. Economic events tend to propel the precious metals and tend to propel them for a while, and that's really always been the case.
Yeah, so it's almost like a lagging indicator that
right.
it'll come through, and because of the big question has been this year, why hasn't gold taken off, right? We all see this inflation, we see the counterpart, but maybe it's going to have a bit of a late spurt, and before the end of the year, we're really moving into that. We're seeing the response, just a little bit delayed.
Yeah.
Okay. Yeah.
I would say, just to answer that question, gold and silver have sideways traded within ranges because even though we've had inflation, it hasn't materially affected the economy in such a way as to cause big wealthy entities to move into gold and silver on a paper perspective. Now, in physical, the physical market's been strong, but on the paper market, which determines spot, people haven't said, oh, we need to buy a bunch of gold and silver. If the CPI keeps going up 6.2% today, if it gets 6.5, 7, 8, and it keeps running like that, that will change very, very quickly.
Right. Okay. Yeah. And yeah, this one of the challenges is this, and you've questioned the legitimacy of a lot of these paper gold and paper silver markets.
Right.
Do you want to just touch upon that? How legitimate they are in terms of their backing, and what evidence is there that there is not full backing?
So I'm an auditor. I was trained at KPMG and EY and worked for a Fortune 13 company doing internal audit. So I did that about 12 years. When you look at the transparency of those markets, I won't even get into the whole audit piece, but if you just look at the transparency of like the COMEX, for example, or the London OTC market, they are not fully transparent. The legitimacy comes from transparency and controls. That's what we talk about in the audit world. That's why we have Sarbanes-Oxley after Enron. Enron showed that we did not have transparency into corporate financial statements. SOX came about. We have more transparency. What needs to happen in the gold market to engender trust is transparency and additional regulations. I believe the CFTC, which is there to regulate it, doesn't have the legislative power to do all the things it needs to do. If you look at the acts that created the CFTC, and so they need more power. They haven't been given that power. And in some of the job that they do, they're somewhat ineffectual in my humble opinion. But that's just because I have a background in the space of regulation. It was my job for a long time. And I look at it from that lens. The question is the COMEX there for physical delivery? I argue when it was first created, it wasn't there. It was for price hedging for producers and merchants to further downside and upside price risk, right? Depending on what you were. If you're a merchant, you have upside price risk. If it goes up, it increases your cost. If you're a producer, you have downside price risk because if you're harvesting corn and you got to hold it for a while before you take it to market and the price falls, you lost money, but you planned on that higher price. So originally those markets, the commodities market, the derivatives were there for hedging. But if you look at the actual trade, you can see an entire year's production of silver traded in a day. So that's speculation. So the question is, when you have highly speculative markets in which a lot of physical goods don't move on a daily basis, are those legitimate at real price discovery? I would argue no. Now, is there nefarious stuff going on behind the scenes? I don't know because we don't have transparency. I don't have the ledgers. I don't have a full end-to-end audit report like you get in Sarbanes-Oxley of American traded companies. So, but the price discovery is not legitimate. It can't be because it's a gambler's market. In a legitimate price discovery market, you have more physical trade and you limit the speculative trading to legitimate hedges. That doesn't describe our commodities markets. How deep that goes, we don't know. We have no idea.
Yeah, and I guess the point you made just before was that maybe gold has not responded because the big players hadn't really gotten to the threshold level of, let's say, concern or inflation expectations to really go for it. But maybe now the threshold has broken and that all this view, the transitory view, no one can really, that it has no leg to stand on anymore.
No.
So, yeah.
I think if you look at the COT report, the Commitment of Traders report from the CFTC, 4 major groups of players: producer merchants, the bullion banks, which are called swap dealers. You have the managed money, which is like the hedge funds. They're in there just to play price. They're not taking physical. They don't care historically. And other reportables, which are wealthy family offices, wealthy individuals, that type of thing. The independents. You don't see small traders in there. If you're a small trader trying to take delivery out of the COMEX, you got to have a lot of money. We're actually doing it. I'm part of a group that has stood for delivery of 5,000 ounces of silver on the COMEX. We have a relationship with Interactive Brokers. We have a relationship with an investor who's funded us, was $100 and something thousand for this. And for 3 months, we haven't been able to take delivery because we're a small trader. We don't get priority. I don't think it's a conspiracy. We just don't get priority. That market's for the big players. That market is not going to move until, like you said, like you mentioned, the big players are concerned. Then you'll see it move. That just happens to determine spot prices. So from a retailer's market, you have high premiums on retail physical goods at all your dealers because the small guys buying physical. That's why American Eagles are $9 above the spot price. The spot price won't move until the big guys get in there and say, "What? We're going long gold and silver." Will that happen? I think there's more reason for it to happen. The timing is always the tricky part, though.
Yeah. I wonder at what point people would actually make that decision, because I feel like if they're not making the decision now, when exactly would it be serious enough for them to do so? And my understanding is that the general sentiment outside of the gold bugs is that this is still transitory, and I just feel like maybe I don't know why that is, to be frank. Why people?
I think people are coming to the realization that that inflation's not transitory. However, the last time the big players really got super into gold and silver was during the financial crisis. If you see a meltdown, like if Evergrande spreads to Europe and spreads to the U.S., not saying it will.
Yeah.
If a debt contagion spread, immediately the big players are in. They're all in. We saw that after Lehman. And not only are they in, they're going to stand for a while until they know that things are back on the mend. Because it takes a while for policy to be produced, for the numbers to come out, for us to get ourselves out of the recession, to destroy, the bad debts, the misallocations. But that's when you'll see the big players move. I would, however, argue, if you look at the delivery statistics on COMEX, the people taking the gold out of the trading arm of COMEX and just into the private storage had been the other reportables, which are the big wealthy individuals. I would argue that wealthy individuals do own gold and silver. However, big business doesn't. The big traders don't right now. They're just plain paper.
Right. And that would be the switch that they would then get in the physical.
Yeah. They would get in the physical, and they would stop shorting the paper trying to make arbitrage price hedges. There's a couple of ways you can arbitrage. You can play options. You can do the EFP, which is exchange for physical, which is the difference in pricing between American and London markets. All of that paper is done just to make a few cents or a few bucks on a contract, right? And they just do it in big numbers.
Yeah.
They'll stop doing that if they we're worried about the dollar, we're worried about bonds. Then they'll move into the gold trade in a bigger way. They're not doing that yet.
Right. Folks, go to Robert Kientz's website, goldsilverpros.com, and check out his book, Drop Shadow: The Truth About the Economy. Thanks for your time. I know you're a busy man, and people should also check out his YouTube channel. He does live streams if you like the quick, free-flowing approach. So otherwise, Robert, thanks for your time. I look forward to we can next have you back on.
Absolutely. Thank you so much for having me on. It was a pleasure.